Hello, my name's Paul Weightman. I'm the Managing Director of the Stara Group. I'm here today to talk to you about the opportunity to invest in Venu Hospitality Fund. In the video that follows, I'm going to give you an overview of the fund, a summary of our investment thesis and why we think it's a really good opportunity, and the key features of the fund and its management team. I hope you enjoy the video. The fund is based on our strong conviction that the next 10 years in southeast Queensland will provide enormous opportunity for investors. Our conviction is based on a number of key observations. The first of which is that population growth and economic growth in southeast Queensland on the back of significant infrastructure development is likely to be the highest rate of growth in Australia that we've seen for some time. It's also based on the observation that there's a high degree of correlation between hospitality revenue and population growth. And if I can state simply what the investment thesis is behind the fund, it is that this is a growth play based on the thesis that we can obtain strong growth, strong upside from the aggregation of hospitality businesses and pubs in southeastern coastal Queensland on the back of the population growth and infrastructure spend that will occur in the lead up to the 2032 Olympics. To that end, we've focused on acquiring a scalable operating platform that can generate immediate upside to businesses and freehold assets to be acquired from the smaller operators that represent 85% of what is currently a very fragmented sector. There's also an arbitrage opportunity arising from the fairly large difference in prices paid for comparable assets in other parts of Australia, particularly in New South Wales. And we see a great opportunity for exiting the transaction to aggregators and operators who want scale in southeast Queensland immediately before and after the 2032 Olympics. I think it's fair to say economic performance in Queensland currently is robust. Indeed, Queensland leads the nation in the State of the States review recently published by CommSec. Queensland's economic momentum is driven by mining, energy, tourism and migration. We're ranked first on relative population growth, 2% in 2022, which is a whopping 30% above the decade average, and looking to accelerate over the 10-year forecast period to an average of 2.2% per annum. What this means is that in 10 years' time, there will be likely to be another 1.5 million people living in this part of the world. Think about what that means in terms of housing, development, household formation, jobs growth and spending. We're also running at an unemployment level of 3.6%, which is 40% below the decade average. The main drivers of food and beverage, hospitality spend are population growth, which represents more than 64% of the reason contributing to that growth, income growth of 6%, and changes in tastes and preferences, which represent about 20% contribution to total spend. As a result of that, there is a high degree of correlation between population growth and food and beverage and hospitality spend. Queensland's coming off a very affordable base. The graphs that are displayed on your screen now show the incredible differences in affordability between Sydney and Brisbane and Melbourne and Brisbane relative to income levels. Put simply, this is not only going to be a great part of the world for growth, but it's also one of the most affordable places in Australia if you want to access opportunity. There's a lot of project work currently in the pipeline. As you'll see on the screen, billions are being spent currently, and the reality is this spend is dwarfed relative to the spend that's going to happen coming into the Olympics. For those of you who can remember the lead up to the Sydney Olympics, there was incredible economic growth. That growth was focused on the Olympic City, with a lot of spend on hospitality assets, particularly hotels, in anticipation of the strong tourism numbers that would be generated. That growth was so large that the Reserve Bank had to move interest rates from the end of 1998 to August 2000 by a whopping 1.5%. Now, this happened at a time when growth in other parts of Australia, such as Queensland and Victoria, were very modest. What it does is highlight the incredible boost that we're going to see to this economy in the lead up to the 2032 Olympics. Indeed, I believe very few Queenslanders have a real understanding of the magnitude of the growth and the upward pressure that we're going to see on pricing, on jobs, on other opportunities in the decade ahead. We're in an interesting period in the economy. Clearly, there's a lot of volatility. We've seen rising interest rates, a fall in confidence. We've seen the end of cheap money and the implications that that has for asset pricing. We're also in a time of rising inflation. What that has led to is a significant increase in the cash balances held by investors. Now, there are opportunities out there. Deposit rates are high. You can go and get an ANZ bond at 6.5% for 10 years. But in a period of moderate inflation, investments like that will inevitably lead to erosion of wealth. Our solution is to identify opportunities for investors to give them the chance to secure not only income, but growth. We've focused on the hospitality sector as an opportunity for a number of reasons. There are clear drivers to aggregation in the industry, coming from a range of factors. You've got a general trend to industry consolidation, and we've seen that in the UK with the high percentage of assets, pubs and the like being consolidated into corporate ownership. You've got groups like Stonegate, Green King, Wetherspoon, Mitchells and Butlers. That's a trend that we'll see replicated in Australia. You've got the fact that operators with greater buying power are able to secure better deals from suppliers. Suppliers favour larger customers. They're able to secure from their suppliers better rebates, better discounts, and more certainty of supply. You've also got the case with operating entities that where they have scale, they're able to secure better deals with landlords. You've got a rising level of compliance, and this is accelerated during and post the COVID period. Small operators find it increasingly difficult to cope with more stringent compliance requirements. You've had the shocks to the labour market, which have reinforced the fact that operators with good labour relations, good migration schemes, and good employment platforms are able to secure the better, the best, and the more committed long-term employees. You've got the impact of technology. You've had a revolution in ordering systems with platforms like Me and You. You've got an increased level of consumption coming off the back of those IT platforms. You've got premiumisation coming off the back of those platforms. And you've got a move to platforms that will be driven by artificial intelligence to maximise relationships with repeat customers. And of course, you've got the need for regular CapEx, for reinvestment into premises to ensure that they have state-of-the-art offers and appeal to more consumers. Take all of that into account. It's harder and harder for the smaller operators, who constitute 85% of the industry, to be competitive. Aggregation is coming, and it's inevitable. Add that to the socio-economic factors that we've highlighted earlier, so increasing spend on infrastructure, population and tourism growth that we'll see leading up to and after the 2032 Olympics, the long-term trends that we've seen to people eating more out of home and less at home, and the figures on that are quite startling. If we look back to 1988, it was 24% of meals were had away from home. That improved in 2018 to 34%. And anecdotally, we've seen increases from there on the back of pent-up demand as a result of COVID. Overlay on top of that the growth factors that come from price compression as the sector becomes more attractive, the arbitrage that we can see between Queensland pricing and other markets, the fact that we can see the opportunity to increase EBITDA and net profit by bringing greater scale, better policies and practices and operating methods from economies of scale generated by larger operators to generate more income that will inevitably attract a higher multiple. And we see that there are a whole range of factors that operate to show that aggregation, growth, and the opportunity for better pricing will all be strong drivers of growth in this sector in South East Queensland over the next 10 years. We're in a current period of moderate near-term inflation. Our thesis is that this will start to flatten as supply chains start to regularise, as we see more competition, and as we see the shocks that have come from things like increasing energy prices start to abate as political conditions in Europe start to stabilise. We're also seeing a very low level of unemployment that's the lowest in Queensland, that is going to be exacerbated by the range and the cost of infrastructure projects that need to be implemented over the course of the next decade. Opportunities attract jobs. Jobs lead to growth in population. One of the very interesting statistics that we see coming out of the recent census and subsequent migration figures is that Queensland has the strongest net interstate migration of any state. Now, Queensland's in the top 3 for total population increase, but you can't undersell the significance of attracting more people from more established places in Australia who have existing consumption preferences, who assimilate easily into an economy and who are more readily employable. Those are other factors that make the opportunity for growth more significant than it would otherwise be simply if we were bringing more people into the state. And finally, from an economic perspective, we're seeing a recovery in terms of the numbers of people coming back into Australia. We're seeing a strengthening positive balance on arrivals, led by students, backpackers, short-term tourists who contribute strongly to the labour force in the hospitality industry. So what is the Venu Hospitality Fund? Its initial portfolio was based on the thesis, as I mentioned earlier, that we want to have a very strong operating platform from which to generate growth. As a result of that, we've got 10 very strong operating businesses that are being acquired on an attractive multiple that have great opportunities for growth because of the catchments in which they're located. The initial portfolio in the fund also includes 2 freehold going concern assets that demonstrate the additional opportunities that we think we can generate in the fund from the application of our investment thesis. The initial portfolio is based largely in southeast Queensland, as I mentioned, in strong population growth areas. Areas like Loganholme, North Lakes, Springfield, Coomera, areas where there are strong levels of household formation and additional home supply. More people with secure jobs equals more customers. Overlay that on the overall long-standing trend of eating out more, and you've got more revenue. The Pine Beach Hotel is a freehold going concern asset that isn't located in southeast Queensland, but is located at the southern end of the axis of growth between Emu Park and Yeppoon. That axis, situated to the east of Rockhampton, is part of the second fastest growing regional area in Australia in terms of jobs and population. Put simply, the town of Rockhampton is moving east towards the coast. This is where people want to live, and it's an area that's presently poorly serviced by hospitality facilities. With the Pine Beach Hotel, we've acquired an asset that has substantial development upside. If you look at the slide on the screen, you'll see that the area on the bottom of the site, marked residential and beer garden, is capable of being developed and indeed has a development approval for short-term accommodation. It's one of those rare situations where you can generate development upside in circumstances where you can maintain ongoing cash flow. The hotel will operate until a new hotel and function facility and short-term accommodation is built, and it will continue to generate income. On completion of the development, we expect to see very good development upside and an increase in trading income. The Beachmere Hotel is situated in the corridor between Caboolture and Caloundra. Between South Caloundra and West Caboolture, we're expecting an additional 110,000 homes to be built over the course of the next decade. This hotel is one that will benefit from upside in the provision of additional retail outlets in that growing corridor over the next 10 years. We're buying a hotel from an existing operator who's had other areas of focus with larger developments and larger facilities that have taken a fair bit of time and energy to develop. We think this hotel provides an opportunity to be regenerated and to provide a range of additional options and offerings to its local catchment. The fund itself will be lowly geared in terms of its gross asset value at commencement. We're borrowing about $14.75 million on a total cost of assets and acquisition of $90.9 million and total gross asset value of $81 million. This not only minimises the potential impact and exposure of rises in short-term interest rates, but it also gives the opportunity to buy assets accretively with additional debt. We've provided for a cap on debt on a long-term basis of 40% of gross asset value, but we see great opportunity in the meantime to be able to utilise the balance sheet to generate additional revenue and value for investors. The fund is targeting a total return in excess of 10% per annum. Indeed, we think we can do well in excess of that over the first 7 years, given the growth opportunities that there are in this part of the world. We think it's important to be able to provide investors not only with a total return, but strong income returns on the way through. We're projecting a year one cash dividend of 7.5 cents per $1 security and franking credits of 2.5 cents per stapled security, with what we expect to be reasonable income growth over the investment term. We're also able to offer to investors a discount on total spend at portfolio businesses of 15% to generate loyalty in our investor base. The operating platform is being acquired from the Raw Group. Indeed, 10 of the existing 13 assets are being acquired, and the managers of the Raw Group are committing to subscribe at least $7.1 million of the proceeds that will come from that acquisition. There are quite a number of investors in the existing Raw Group. Some will choose to exit, but the key managers in the business are choosing to stay involved, reinvest into the business with an eye to taking advantage of the growth opportunities that they see will come from either organic or acquisitive growth in the platform. We believe a significant co-investment by the management team will provide strong alignment between the interests of the manager and the interests of investors. So how do we achieve growth? We think there are great opportunities for organic growth. The operating businesses are scalable. Relationships with landlords are strong. We think we have great opportunity to open additional venues under either the Beach House name, Madame Wu, Chew the Fat, or Casa Chibo. We believe there's strong opportunity for improvement in business efficiencies in the assets that we will continue to operate or acquire. The operating business and the manager work to a simple philosophy. Year on year, look to achieve 1% uplift in revenues, 1% reduction in cost of goods sold, and a 1% reduction in operating expenses. That flows through to a 10% uplift in EBITDA. We believe growth will come through better use of technology and continuing application of the strengths and economies of scale and buying power. We think there's upside through asset enhancement and development. My background is in real estate investment and development. I've overseen the development of more than $2 billion in assets. That development has invariably been profitable. We see the opportunity for growth through acquisition of businesses. Those are the businesses we've referred to when we talk about a fragmented industry with individual operators. We think just through a combination of operating efficiencies and better buying power, we can improve EBITDA in those businesses by up to 20%. And finally, we'll see value growth through arbitrage. the compression of pricing that we believe we'll see as we come into 2032 Olympics. The fund has a novel structure. It's a corporate collective investment vehicle. That structure was introduced by the Australian government in July last year, and Stara is the first manager to be granted a CCIV management licence. And this, the Venu Hospitality Fund, is the first fund to be promoted commercially in Australia. It has a number of advantages, and you'll see more on our website when you look at the paper that's written on corporate collective investment vehicles. But it offers efficiency, simplicity, and above all, a structure that is tax efficient. We're offering stapled securities representing a share in each of the two sub-funds in the corporate collective investment vehicle at $1. One share is referable to real estate, one share is referable to the operating platform. I'd encourage you to look at the information memorandum for more details about the limited quarterly liquidity facility that we're offering to investors and the major exit or liquidity options for the fund in 2032, in the lead-in to the Olympics, and in 2035, where we think there'll be opportunity to take advantage of the post-Olympics tourism boom. We're looking to raise $75 million in this offer. As I've said, $7.1 million of that, as a minimum, will be contributed by the management team. We're often asked, who does this fund compare to? Where do we sit relative to other large-scale hospitality businesses? Well, we can look at ALE, which was recently sold to the Charter Hall Long WALE REIT Trust. It was sold at about a 4.7% yield. The ALE Trust highlighted some of the issues that you can get when you don't have strong alignment between the operating business and the owner. And the sale was driven largely because of uncertainty of future rent reviews from an operator. We look at Redcape, which is an owner and operator, which has demonstrated returns since inception of about 7% per annum and a 17% total return. We think it's the closest comparator, although it is New South Wales dominant in its portfolio and has a much higher proportion of revenue attributable to gaming. There are tenants like Endeavour and Australian Venu Co who trade at very tight yields. But we believe Venu is distinguishable because it owns, operates, is capable of organic growth and expansion, and will look to develop assets. The Venu Hospitality team comprises executives from Stara, myself, Jody Clark, and Patrick Weightman, who are pictured on screen, Steve Denise, who has a long history in the hospitality industry, and Nick and Adrian Rosado, the principals of Raw Management, who have at least 20 years' experience in that platform and nearly 30 years of experience in the industry. We believe the Venu Hospitality Fund provides a strong growth story with a capable and experienced management team that can drive returns and that can drive a successful investment for interested investors.